based on our third quarter. Immediately. Sorry about that. Once again, welcome to this investors briefing. It relates to our third quarter performance. And without much ado, looking at the environment, the macroeconomic environment, we seem to have a regional outlook that reflects narrowing gaps between inflation, GDP growth rate, and interest rates within the whole region. If you look at interest rates, the central bank rates, they're just the variance other than Rwanda. It's almost the same. When you look at inflation rates, the range between the countries we are operating in is low, and almost it's harmonized GDP growth rate projection for 2019. When we look at a deep dive, we see what one would regard an enabling macroeconomic operating environment. Not much one would really protest about. There is positive sentiments across. And for that reason, then we have just looked at how well we are prepared, the governance structure within the organization. We have continued to strengthen the bank oversight responsibilities. And maybe this would be a good opportunity to introduce a couple of people who we have brought on board to strengthen the team that is providing oversight, particularly in the corporate officer. So the group directors who have not had an opportunity to attend an investors briefing, Lanley, there you have, Inka, John, and who else? And maybe very good. So the three of you, maybe you could come forward quickly. I'll give you 2 minutes to introduce yourself. Raphael, we can start with you. 2 minutes of introduction.
Thank you. I have most recently joined the bank as the director for corporate subsidiaries, in charge of corporate banking for the subsidiaries. I joined from having worked for Standard Chartered for 16 years and with EcoBank in Tanzania, served in China and Dubai and Singapore previously, looking after commodities and local corporates. And we look forward to transforming the corporate banking space within Equity Bank. Thank you. Yes, my full names are Raphael Onyango.
So we hope Raphael Onyango will be as loyal as he was to his former employer. He's still introducing himself. But essentially what we are recognizing is that our balance sheet has grown to a level that we can't avoid playing in the corporate section. Whether it is 2 or 3 loans, we need to manage them very well. And so Raphael will really manage very closely the corporate portfolio within the group. Our focus is not corporate, so we don't need to establish corporate in any of our subsidiaries, but the outlier loans in each of the subsidiaries then will be under Raphael. We also recognize that what attracted us most to Onyango is his depth in commodities. And we realized most corporates that might come our way may have something to do with either agricultural commodities or mineral commodities. So we needed somebody who has that real depth so that we manage that risk upfront. Inka?
Good morning. My name is Yinka Adedeji. I joined the group from United Bank for Africa. I ran payments for UBA for 14 years, over 20 countries. So joining the group about 2.5 months ago, I plan to pull all the payments under one umbrella and run it across the group with proper structure. I've met with many of you in many instances where we work together. You will have seen examples of the fact that we're here to really build payments as the basis of doing banking in equity and in equity way. So I'm here to drive One Equity through electronic and digital payments, and I look forward to working with you. Thank you.
Thank you very much, Nkas. He has really a little bit tweaked to the business model. We have realized banking is centered on intermediation, but a deep dive on intermediation, it became apparent to us that only 10% of our customers have loans. And we said, then why do we always talk about loans? Then we looked at only 16% of the depositors who constitute 60% of the deposits. We said, what is missing out here? 14 million customers, only 800 have loans. And we realized that most people want to be facilitated. Most people want to be enabled lifestyle. And when we really did a full analysis, we realized people want to be facilitated as value exchange hubs. As value move from one hand to, that is really what the banking is all about: payments, processing, transfers, and the rest. And then we said, the new model will center on payments. So we lifted payments from a department leaded to a directorate. So we have now 3 genes: credit, operations, and payments. And we expect payments essentially to help us maybe to achieve more than 50% contribution to total income coming from non-funded. That's the real objective, really objective. So we'll really be big in the payment space, unless I have misrepresented you. Very good. And lastly, John, you have 10 minutes.
I don't need 10 minutes. Thank you. Good morning, everybody. My name is John Wilson. I joined about 2.5 months ago from across the street, the World Bank Group. I've been in Kenya for the last 11 years, mainly looking at banking across East and Southern Africa most of the time. At the end, managing IFC's portfolio in this part of the world. And the way I think about my role is primarily as building a structure around this bank as we become larger, as we move into more markets and more complex markets, to organize the structures and make them work in a more maybe bureaucratic way, because we're going to need that. We're going to be entering more difficult times, creating a factor in the middle that can deliver all the services across a much bigger group cost effectively. So those are my main roles, I believe.
So maybe, John, before you disappear, as John has said, we were lucky to get John from the World Bank Group. He was the global banking specialist, global commercial banking specialist. So it's essentially bringing the technical aspects of commercial banking as maybe practiced by the World Bank. 2, he was the head of financial institutions, or the financial globally that align to IFC. And so he brings the wealth of managing. So if you look at the 3 of them, it is people who have played on large networks, minimum 20 countries. So essentially, we are building our skills and competence of managing a regional bank with 10 to 15 countries by the year 2025. So have the right skills before you plug into doing. And essentially, that's the skills and the competence, so that we don't have to make the mistakes that have been made before by others. Lastly is managing One Equity. Because they are at the group level, it's at the corporate office, that's why the concept of One Equity. So the 10 countries being managed as one entity on a platform. So thank you very much, John. So that strengthens. The strategy has remained the same, looking at areas. And I know we'll talk a lot about interests. Looking back, would say the last 3 years of interest capping gave us an opportunity to reinvent ourselves. We saw interest capping as a new norm. And so essentially, the bank has been able to reinvent itself through these 8 initiatives. And essentially, we are where we were before the interest capping in most of the aspects. We have fully transformed ourselves those 3 aspects. So interest capping removal can only be a bonus, but not something that really can be, and is unlikely to change the bank from a strategic perspective. It can only lift us maybe to the next level. So if we look at non-funded, because this is very central to us, we continue to see that the interest income trend now is growing back to prior interest capping rates. We can see 12%, and when you break down total interest growth, we see 11%, suggesting that treasury and loan interest component. And essentially, with 32% of the interest coming from the Treasury Department, everybody can see the upside that carries with that, because that's a low yielding asset portfolio. But look at the non-funded growing at 14%. And consequently, when you look at the total income, we are back to pre-interest capping rates. It's no longer when we were growing at 1%. As we can see, we have been able to completely adjust ourselves, and we could see a growth of 11%. When you look at the diversification, we now see that non-funded income has managed to hit 41% contribution of the total income, and that compares to our peers at 37. So we are 400 basis points well positioned from that. And the objective of payments now is to move that 41 to 50. Where we'll get 900 basis points, we think it is in payments. So it's a transfer of value, and will be very, very big in that space. Non-funded speaks to quality of earnings. That's really, because that's really realized income, and there is no fallback. Treasury has become very efficient because of managing 27% of the total portfolio. And we can see it's the mix of the income there is very interesting. It is from government stock, 72%, 16% is Forex. And that is why we are very excited that Treasury, now it's not basically based on funded income, but a significant portion is coming out, 28% is coming a little bit outside Treasury board's income. But we can see proactiveness in the last section of the slide, whereby we have capital gains that has not played in the profitability of 108% that has been generated during the year to almost 3 billion shillings. And so as interest rates fall, that capital gain continues to grow. And again, that compensates us significantly from any trade, that negative trade or declining interest rate on Treasury boards. The second aspect was diversification within the region, and we are very excited that despite South Sudan and the slum in Uganda, we still are seeing positive growth in the subsidiaries. We can see the subsidiaries growing their assets at 26%, when Kenya is growing at 21%. So still outpacing Kenya, and now contributing 27% of the total assets. So we're not far from our target. We just need to increase that by 13 basis points, and we reach 40% And we can see that happening maybe in course of next year. And essentially, we have achieved a very diversified sovereign risk, such that the concentration ceases to be. And the next slides then tells us the performance. And we have debated a lot about capital allocation, but it's very satisfying to see Uganda, Rwanda, and DRC are now able to have a return on equity higher than their cost of capital. So essentially, anybody who had been concerned about capital allocation now sees that the regional expansion strategy, the regional diversification, the management of the sovereign risk concentration has paid off. And these subsidiaries can only go one way, like they have been going, up and up. And so when you look at 23.9 for Rwanda, it means that Rwanda can easily outperform Kenya within a year. And we expect next year that Rwanda might perform better than Kenya in terms of return on capital. And so that justifies essentially the regional expansion, that you are diversifying sovereign risk without compromising return on shareholders' funds, or without the capital risk, essentially. And of course, the ambition that we have been talking about, we see the countries of focus. And I think the issue is just see it is more just creeping expansion strategy. It's not moving from East Africa and tomorrow you are in North Africa, and the day after you are in West Africa, and the third day you are in South Africa. No. It's just slowly creeping, the way we never tell how temperature has changed as we move from one region to the other. So we don't expect the regional expansion to be disruptive in any way because there are no cultural shocks. It's simply a broad expansion. It's the broad that is expanding in a geographical footprint. But more importantly is to see the marked lines, that the expansion is guided by trade routes. We just, in one way or another, focusing not on a geographical space, but on a trade route scenario. It's the business that we intend to facilitate. The interesting one is the agility of the bank. And if there's one thing that I would say we have been able to really achieve in a big way is the diversification of funding, creating very significant stability. The first one, and this is something that we are very proud of, is that we have bounced back to liability growth rates pre or interest capping. 2016, our deposits grew by 9%, and we can see we have now grown at 19%. We have overcome the shock of interest capping the market. And given that the market is growing at less than 10%, it means we are growing at about 3 times the growth rate of the industry. So it's an issue of market share in terms of funding, and 19% growth rate in funding of the given our size as a market leader, when then you outperform the whole industry, it means that there is consolidation at the customer level, at the market level, not at the actors level, at the market level. And whether the market has signaled as the safe, secure place for their deposits, whether it is efficiency in service, that is an equilibrium we are not keen to disturbing. We like the picture that is emerging of confidence, of trust in the institution, and the growth of liability speaks very loudly about the performance of the brand. And if there is anything we will protect, is that performance of the brand among society. This is not the bank's decision. is the customer's decision where they keep their money. And we celebrate that they have chosen to disproportionately honor us with trust. And consequently, if we look, we see deposits are contributing the liability side, and we know how when it comes to funding of a franchise, the deposit cost, weighted average cost of deposits is about 2.4. 2.4 cost on 71% of the total funding. We know capital is very expensive. We would be talking of maybe 16% cost of, or 17% cost of capital. So when you look capital, then only becomes 16%. And then long-term debt, to ensure the mix, there is no mismatch, is 10%, costing us at an average of 3.7. Weighted average cost of funds coming to 2.7. Then it shows the mix, and equity's greatest strength is identified by that slide. But it's the mix that we celebrate and what it speaks to, the confidence that long-term lenders can give us 66 billion to ensure that we don't create any mismatch between the liability side and the asset side. And that trust has been paid back in a big way. And maybe this is the most important slide I'll talk about. And we don't need to talk about interest capping and repeal of Section 33. Why? Because as we can see, the net loan book is growing at 21%. The industry is growing at 4%. We're growing 5 times faster. Equity has developed what one would call a recipe of operating in an interest capping environment. Interest capping for us is a new norm. It has helped us to be in a very good position, an equilibrium position where loans are growing at 21% and funding growing at 19%. So our focus is not about this, is how can you grow the balance sheet even much faster. So, and that's why I said we don't want to disturb that equilibrium. The focus of management is this strategy seems to have put us in the right place. How do we scale ourselves? Because we saw a return in Kenya of 27 point, and capital is at 16. So the capital is enjoying a premium reward, a very premium reward. So how do you scale at that level of equilibrium? And again, when you look at the asset distribution, to confirm what I'm saying, you find the growth rate on loans is at 21%. And now we are busily reallocating. Treasury growth in investment in treasury stock is decelerating significantly. The last time we were here, we were at 25%. We are down to 5%, and we would like to see much of that now go to credit. And I would not be surprised if by the end of the year, we'll be registering a 30% growth rate in their own book. Why? Because it's a very appropriate equilibrium position. And we would not like to be sacked and disturbed by what is of interest to others about interest capping or removal of interest capping. We are at the best position that anybody could ever be. Look at the cash and cash equivalent, 40% growth rate. And the question is, how quickly can you deploy that 110 million into loans? That is what this focus is for the bank. And of course, the mechanism of deploying that is what is even more exciting. And that's why we are saying we're not going to disturb this equation. We see now the distribution, the customers are now on a self-service platform. Digitization has helped us. If you look at the percentage of customers using the mobile platform and third-party agency platform compared to the customers using our infrastructure, the brick and mortar, the fixed cost. The business model has completely changed from a fixed cost model to a variable cost model. It's third-party infrastructure. IFRS 16, as you can see, has been dealt with a big blow. We have moved away from fixed cost infrastructure to third-party, but more importantly, to self-service. We don't need to continue hiring staff. The customers serve themselves. If the customers are serving themselves, then they serve themselves wherever they are, whatever time. And that compression of time and geography then makes the bank a 24-hour banking. And you can imagine the convenience that comes to the customers. And when you go down into what these channels are, when we were here earlier on, we were celebrating digitization to the individual, personal digitization, the individual. If you look at what the story now is this digitization of the corporates and the business segment. And there, if you look at Forex, volume of transactions. The last time we were here, the customers were served in the branches if they wanted to buy foreign currency. Now they are buying it online. You buy credit to your account, and you go and withdraw from the ATMs, or you pay directly from your internet or because you have the foreign currency on the devices. And we can see that's the fastest growing delivery channel. If you look at EasyBiz, which is corporate internet banking, so far this year, it has handled almost 320 billion shillings in volume. And as you can see, it now has outpaced mobile. So internet banking has taken and is challenging the mobile capability. So digitization now has gone beyond mobile banking to internet banking. And now the whole customer segment is digitized, and we are now in a virtual space. Both the corporate customers are now serving themselves. If they want foreign currency, if they want to do payments, if they want to borrow, they no longer need to come to the bank. And we couldn't be in a better position. And so see where the debate is. The conversation is not going to be shaped by the market. And as we can see, the brick and mortar, the fixed cost channels, ATMs and branches, you can see the volume of transactions are going down. But the value of transaction continues to be high. Why? Because they are only dealing with high value transactions. So essentially what we wanted the branches to focus on is exactly where we are. It has been a journey, but it appears that we are where we wanted to add it. And of course, these are very significant ramifications in terms of cost-income ratio and efficiencies and convenience to the customer, and ability to deliver a uniform customer experience. That is, to us, is the most important aspect, the convenience to the customer and a uniform, branded customer experience. And when Inka talked about one equity, it's one equity because the engagement, the interaction is the same for all customers. We have removed the human subjectivity because the bulk of our customers are serving themselves. And we can see how quickly we have been rewarded when we look at the impact of digitization at the agency banking level. And we can see the volumes that we are dealing with. And digitization. The orange bars reflects depositing, people converting cash to digital currency through putting money in the agents. But you see, they never go back to the agents to withdraw. They use the money now in its digital form. There is internet banking or mobile banking. And that hopefully shortly before the end of the year, we shall even add now social channels, such that we really complete digitization on the social space. And essentially then we have delivered the convenience and the freedom of choice. That is the customer who drives the channel they want to use. And they will be channel agnostic. They can, all channels will provide the same suite of products. And so essentially, when you look at merchant banking, this again, look at how our merchant banking has become the market choice. Well, you look 27% growth in volume of merchant banking. Merchant banking is when you swipe to make payments. And we are now saying, can we digitize the merchant banking? And we shall see the next slide, that this is the POS-based merchant banking. We're now bringing in the digital mobile-based merchant banking, EasyPay, and the experience is the same. So 91% growth in number of transactions at the merchant's level, almost doubling the number of transactions we had done last year, and almost increasing that by 150% in volume. I truly believe the market has not grown at that level. What it has meant is that we have crowded out competition, and the market share has become very significant. And that is really the power. We are now reaping the benefits. And this is the equilibrium we want to protect. We're in the right place, the desired place, the strategic place that we intended to be, where we are in control of the levers and we can really move the recipe to get the taste and flavor that we want. And that's what we will jealously protect, and will not be dragged into side shows. When you look at, this is the agency, again, EasyPay. Now move from POSs. The barrier in merchant banking has been the cost of a POS. We've now gone to the mobile POS. Your phone is converted into a POS, and we can see the number of transactions, again, has grown by 91% and 149% in the volume that is being transacted. Winning for us will look like when retail commerce stops using cash, and we buy sukuma wiki, we buy bread, and we buy milk at the kiosk digitally, electronically. And that this is what it means, how quickly we are being embraced. We now have 46,000, if I'm not mistaken, of these easy pay merchants. And these merchants can do much more than payments. They can also do transfers and exchange of value. Again, digitization when it comes to diaspora remittances. We are talking about annually about 200 billion of remittances. As we can see, by third quarter, we had already handled 101 billion, suggesting market share now has gone far beyond 50% of all diaspora remittances coming to the country. And we can see, yeah, we have managed our grid. It's not about how much we charge. It's whether we offer that service. And transfer commission is not the focus. The focus might be access to exchange rate. And what we have seen is that when it now comes to our Forex dealing, you see we are overcompensated because 25% of all the Forex that we deal with is now coming from diaspora. We have an assured source of remittances. So as a bank, we will now become the biggest player in trade finance simply because we have an assured source of Forex. Yes, I can see now it has clicked to you that truly we have captured the market where we wanted to be. And so essentially we can see diaspora flow accounting for 23% of all clients' Forex volumes. And that was, and then growing at 20% because of the assured flow of Forex. And of course, then when we look at the graphic model, we can see we have moved from the mobile from 76% to 77%. And we can see mobile is now marginalizing all the other channels. So digitization has worked. And the next thing we'll see, the next big thing we'll see is internet banking now taking over because the corporates have also adopted it. They no longer want to come to the bank. They also want to do everything they do on internet. And we can see the only remaining thing is high-value transactions. The only ones that go to the branch. And mobile loans, we have seen, we have moved very far in terms of branch lending and mobile lending. And 93% of all the lending we process are still at the branch level, as we said. But the issue that occupies staff is not the volume, is number of transactions. So that, and we can see the net effect of that on efficiency and cost of optimization. And we are in a celebration mood when we look at Equity Bank Kenya cost-income ratio moving from 47% to 45.9. Now, cost-income ratio moving down that way when the balance sheet is growing at 21%. You just imagine, traditionally, such a growth would have pushed back the cost-income ratio. It could have gone the other direction because of investment to handle the increased volume. But it's now volume increasing, and volume means opportunity to earn, while the cost on the basis of which you earn is going down. And that has influenced the group level, that even at the group level, the cost-income ratio is coming down despite what we saw growth in balance sheets of 50% in Uganda and DRC. Despite that very rapid growth in subsidiaries, the group cost structure is going down. And consequently, if you look at it, the reason why we said, and we studied very carefully about interest capping removal, it doesn't affect us much because we are achieving this efficiency at very low yields on interest earning. So although interest capping allowed 13%, as you can see, our weighted average yields are at 10.8. Still, there is a huge headroom, even within 13% interest capping. For us, we can still increase the yields 200 basis points. And given our size, 200 basis points is enormous value that can be generated there. And that is why we said we don't want to get into debate the capping, because even without capping, there is an opportunity for us to increase our yields by about 200 basis points. And I think, again, the cost of funding, if then you go to strategy, you can then say, it's interest capping, but should I focus there or should I focus on volume? Why? Because of this right. You could create barriers to entry for other players because you're able to undermine them at yield level and you're able to undermine them at cost level, cost of funding. And when you have those two powers over the market, that's what we call the equilibrium position, and we really like to. And the last one, really of great interest, is the distribution. And if you look at where we are, the bank is operating at the real segment. And the real segment that we would talk about is 57 plus 3. That is 60% of the entire portfolio is in the micro, small, and medium enterprises, MSME. And then when you add the large SMEs, you get 74% of the does it speak to? It speaks this bank, it is at the center of economic activities. We have plugged the bank at the real economy. The real economy is in the private sector, and the real economy for Kenya is in MSME, the micro, the small, and the medium, and the emerging graduating enterprises that have not become corporates, but they have become significantly large, and we treat them differently. They have governance structure. So essentially, 74% of the entire bank is now in the real economy. Let me call it the real economy. And again, that is the desire of anybody. That would be the ambition of everybody, to be at the center of the real economy. And as we can see, only about 26% that goes to the households, either to finance agricultural activities or to finance social investments in health, in education, and small dreams of what we Kenyans we like calling hustling. So that segment then gets 27%. The individuals are getting 27. The households are getting, the individuals are getting 27, and the households in their economic dreams, they are getting 74% of the allocation of resources. And so we are studying very, very keenly the president's memorandum. What was it that was intended to be achieved? And we can't wait to see the new monetary and economic policies that will be driven by the president's memorandum, because they will be at the center of economic activities. They will be the center of real economy. And when you look at the real economy, we are talking about trade, we're talking about housing, energy and water, transport, and all the segments are very diversified portfolio. And again, we see the prominent role Kenya is playing, and we can see foreign currency denominated loans are now constituting 27%, again, showing where the bank is playing, supporting regional trade. And that explains why we needed people like Rafael Onyango, people like Ninka, and people like John Wilson to really focus on the regional approach. Again, that slide speaks heavily. And again, this is something we are very, very proud of, that we have managed to maintain very high quality loan book relative to the industry and the sector. We are 400 basis points lower than the industry in terms of non-performing loans. When the industry is at 12.67, almost 12.7, we're at 8.3, suggesting that we are 430 basis points lower than the industry. Again, that really shows we can play on a different tandem from the industry because of the efficiency. And that we are excited. The second excitement is that the loans that constitute that NPLs are in SMEs and large enterprises, suggesting they are well secured, very well secured. So potential loss is minimal. And we can see, despite that minimal potential loss because of fallback on securities, we still have coverage. And particularly in Kenya, of 78%, because that's where the challenge has been. And so even when you look at the composite, you see the contribution from the countries that would be of concern to us. And essentially, we are a community bank. As we said, we are at the center of the real economy. How do we engage with the public and the broad performance. And we have invested significantly. As you can see, we are slowly moving from philanthropy. Philanthropy is where we started in Wings to Fly. But now we are increasing social and impact investments. And if you could look, it is entrepreneurship, it's agriculture, Alex, one slide back. It's health, it's energy and environment. Things that we can transform society, but transform using an economic model. It's not philanthropy, it's social and impact investment. So that can be done commercially without having to really rely on a philanthropic approach. And that really prepares the market for commercial engagement and the softening on the blood and that. And in terms of numbers behind that, we see the scale at which the bank is operating is very, very high. If you look at women and youth trained in financial literacy, that is 2 million young people. Young people, we mean from the age of 24 to 35. They're active, they're ones entering the economic space. And when you train 2 million, it means you have trained more than 20% of the entire country's youthful population. Now, you can see what that means in terms of market size and the potential of equity to grow, particularly its loan book, and to institutionalize itself on the liability side as those people become active savers. When you look at agriculture, we started dealing with the peasants and turning them into agribusinesses. Look at the newfound focus in the medium-sized farms. Why? Because we are reorganizing and we want to create an outgrowers model where we support the large and medium-scale farmer, and that farmer become the aggregator of all the peasants farmers or the agribusinesses within their region. So reorganize the entire agricultural ecosystem in the country in value chains using the small and medium enterprise. I must say this, we've really been supported by Labo Bank, the world's largest bank. It's helping us to, Esther, where are you? Esther is our Associate Director for Agriculture, and Labo Bank has seconded an expert. Is he in the room? It is revealed, again, to ensure that we're able to reorganize the entire agricultural sector in the country. And that is really that's the equilibrium we don't want. If you are in the SMEs and agriculture, then you don't want to, and we can see 45,000 micro, small, and medium enterprises being taken on a 3-year entrepreneurship journey. So essentially, we become the aggregator of the market. The bank continues to enjoy very, very high global ranking ratings and accolades. We're very, very proud. We still enjoy from Moody rating, sovereign rating. We still maintain our global position, our ranking in the global banks. The African Banker, still African Best Bank, GCR, sovereign rating, SME, the dominant bank, digital bank, best bank in Africa, and the brand continues to resonate. So I think I will leave you this to look. And relative to in the banking industry, we become an outlier in every segment of banking that we play, the franchises. And the market has not been bright to this, and we see in market capitalization, we are still 30 billion shillings larger than the second biggest bank in the country, in the Nairobi Stock Exchange, placing us as the largest bank in East and Central Africa in terms of market capitalization. So we see that we are communicating effectively to the investor community. When we then look at the balance sheet, as we have said, has grown up by 21%, moving from 560 billion shillings to 677 billion shillings, suggesting we have added almost 120 billion shillings in 1 year in the balance sheet. And when you look at how that is funded, as we said, the biggest funding is coming from depositors, matched by shareholders. The shareholders are consistently increasing their funding to the bank. The global capital also taking its rightful position, and total shareholders' funds underpinning that total funding, of which we now see the focus is on loans, growth of 21%, and cash ready to be converted as we turn around. When we then go to the processing, the outcomes, we find we have been able to reverse, as we said, the negative impact of interest capping and interest income growing at 11%, net interest at 10%, outperformed by non-funded income at 14%, and consequently increasing total income growing faster than net interest income. And there would be no better position we would wish to be. And if INCA then pushes the non-funded to 50% of the balance sheet, we'll see that reallocation outperforming. Why don't we focus on quality of the balance sheet? Let's ensure we acknowledge cost of risk, and let's provide for it. And so we have a 42% growth in cost of provision, loan loss provision. But as we have seen, despite a 15% salary increment to staff earlier in the year, the cost of staff, because the bank is digitizing, despite the hiring of like the corporate team we have seen, the cost is still manageable because the bank is growing faster in terms of revenue than the cost and other operating costs. And that's the number to watch. The last year it was growing at 35%. We're down to 10, and we expect by next year that number should be tending towards 8, David. And that is what will drive the cost-income ratio. As we expected in Kenya, we had given ourselves 5 years. We're down to 2 years. By next year, we expect to be nearing the 42% cost-income ratio, where we expected to be in 5 years in Kenya. So with the trend, it means that we can achieve the 42 at the group level in 5 years. And so the bank has registered a profit before tax of 24.78 billion, up from 22.4, a growth rate of 11%, profit before tax, and a profit after tax of 10%, up from 15.8 billion to 17.5 billion, and reflecting an improved return on average equity in Kenya, 27%, at a group, 23%, and again reflecting that the subsidiaries are now covering significantly their costs. So we just want to expand that. And looking at the ratios, again, improved significant ratios. Capital is adequate, and the most significant ratio there you may want to pick is Kenya liquidity at 59%, showing really the opportunity the bank can have to reallocate. And looking at what we had planned for the year, again, very pleasing to see that we have outperformed the outlook that we had at the beginning of the year. Alex, next slide. Whereby loan growth we had anticipated will not exceed 15%, and we are already at 21%, and we believe that we should be able to close at close to 25%. So almost creating a momentum that next year we would be talking of a growth rate of, and so the debate about interest cap removal is dead on arrival, because what we want to do is to reallocate the 51% liquidity into earning assets, is to grow the loan book significantly because of the 27% return on equity in Kenya. And the non-funded mix grow again significantly. We're almost there. We haven't reached there fully. Growth in deposit, maximum was 15. It's at 19. And return on equity is at 23, where we had targeted it to be. Return on assets slightly higher than where we had targeted to be. Cost of risk, roughly where we targeted it at. And NPLs slightly higher, but we are very confident we'll be around 6% by the end of the year. We seem now to have a grip, and we are seeing a turn there. And subsidiaries contribution, we're targeted minimum of 25. We are at 27, and so we are very confident about the outlook of the future. So in a nutshell, let me try to, where is my friend Bera? He's not in the room today. Very good, Bera, let me preempt your question about interest capping. And essentially, because I don't want to be derailed, the issue is focus on expanding and growing income. When I looked at the president's memorandum, the issue was, how do we get credit to flow to the SMEs? And I looked at our balance sheet and said, we're in a very good position. Our return on equity is 27. Our cost of capital is 17. Which would be better? Margin or volume? And the consensus was, because we are liability driven, why don't we really go for volume? So we'll be looking and partnering with the government to ensure that that credit flow really happens. The second thing is that data suggests, and I can quote authorities managing our monetary and fiscal policy, that the economy is softening, and the private sector is not in very good health. And the question is, would you wish to increase interest in a softening economy and then resort to bad loans? And our vision is, why don't we reduce our NPLs from 8 to 6? That really becomes the focus. And you don't do that by increasing interest rates, because the economy, and I quote, it's not that that might be the best desired strategic position, but the economic state. Until you see the economy change, if the economy continues to soften, then NPLs can go up, and that will be more expensive than enlarging margins. And the last one is 59% liquidity. The yields on treasury bonds are on a downward trend. 90 days treasury bills at 6. Would you be better off at a yield of 13% as opposed to a yield of 6% on treasury bonds? So you saw the reallocation, that there is a very huge deceleration. And again, what would help us? High interest rates may not be the right regime for us. The question is, relocate from like what we said, near cash, 40% growth rate. How do you reallocate that near cash or cash and cash equivalent to a yield of 13%? So essentially, you can make a lot of money by taking advantage of the agile balance sheet. if I look at a couple of slides that maybe make sense, if you look at these slides, Alex, you are putting slides that, yeah, this slide. This is what is confronting us, Bella. I want to address myself fully so that there is no question from you. Cost-income ratio coming down from 47. So I can get, instead of focusing on increased interest, I can lower cost-income ratio to 45. And I will unlock much more than a 200 basis point because this is on entire revenue. That's nice. The second one, I will not give you the microphone, as I'm glad. The second one is return on equity, 27.6. We feel that's a very good place to play it if the cost of capital is 17. And then yields on earning assets is 10.8. If we reorganize the assets, like what we are saying, move the 6% treasury bonds to loans at 13%, the yield can move from 10.8 to about 12.5. And if we manage to do that, again, that really gives us about 300 basis points. And then if we are able to reduce the provisions by lowering the cost of funds to about, NPLs to about 6%, then that would really be. And even if then you look at the overall position in the next slide, Alex, you'll see that the liquidity that we are talking about of 59% is a huge challenge for us. We would like to get it out. The issue is not liquidity. The issue is that the growth in deposits is very high, and we want to reallocate it. Instead of reallocating that liquidity to treasury, to real economy and scale it up in an environment that we shall not create NPLs. It's about efficiency and cost maximization. Thank you very much for listening to the presentation. I think now we have a